Hey guys, Steve Simpson here with Central Florida Property Management. Hope you guys are doing good. Wanted to chat real quick about how to handle your taxes on your rental property, things to go into it, all that sort of stuff. We get a lot of questions from our clients about stuff like that. So the best way to think about your rental property from a tax perspective is to just think about it like a business. And if you don't know anything about business taxes, businesses are taxed on their net income, not their revenue. Net income is basically revenue minus expenses. So just as a very easy example, if you ran a lemonade stand, your revenue is how much money you made selling lemonade. Your expenses are how much it cost you to make the lemonade, and the water and the powder or whatever it is. And then the difference between those two is your net income. Rental property is the same way. So your revenue is basically your rent and any other kind of charges you get or fees you collect, whether it be security deposit withholding, late fees, any sort of, fee that you charge the tenant to move in, whatever it is. And then you subtract pretty much all your expenses. Now, for rental properties, what's nice, what you might not know if you're a normal owner-occupied homeowner, is that a lot of things that as a homeowner or an owner-occupied homeowner, you just pay to basically live in the property. For a rental property is an actual expense, namely property taxes, homeowner's insurance, HOA payments. So if you own a property and an HOA, and obviously you're most likely paying property taxes and insurance, if you live in that house, that's just kind of part of what you pay to live in the house. But if you rent the house out, those are netted against your proceeds to reach your net income. Additionally, you have the obvious things, repairs, obviously if you're paying a management company, management fees, landscaping, like I mentioned, HOA dues, all that sort of stuff. Another big one that you have, which is great, is depreciation. Depreciation is what's called a non-cash expense. So you're not actually paying money out for anything, you're not actually spending money, but basically it's taking the depreciable value of your property on an annualized basis and you're netting that against your revenue. So just for example, if your home was worth $100,000 and we were depreciating it, $3,000 each year. Basically each year off of whatever your actual cash net income was, so revenue minus expenses, whatever that was, you subtract another $3,000 and that would be what your taxable income is. So very often, even if you are making money, like on a cash basis on your rental property, your taxable income will be negative. It'll be a loss because when you factor in depreciation, a lot of times it kind of pushes you under there. Now, if you're using a management company like us, one thing to keep in mind is that when we send you an income statement for the year, it is only counting items that ran through our books. So if we're collecting rent, it counts that. If we're paying out expenses, repairs, landscaping, what have you, our management fees, it counts that. But we, like most management companies, we do not pay your mortgage, we do not pay your property taxes, we do not pay your insurance, we probably don't pay your HOA dues. So if you're paying that outside of us, you're gonna wanna make sure you include that as expenses on your tax forms so you properly account for what your net income is. I know that sounds maybe kind of basic to some of you guys, but I know if it's your first time having a rental property, you're probably confused as to how this works. Hopefully that provides you with some guidance. If you guys have any questions, please give us a shout or shoot us a comment below. And yeah, hope you guys are doing great.